Small cap stocks, the scrappy underdogs of the market, are either your ticket to generational wealth or the fastest way to watch your portfolio do a disappearing act. And right now, the conversation is getting loud. We're talking about a corner of the market that has quietly outperformed large caps by nearly 2 percentage points annually over the past century, yet somehow still flies under the radar like it's in witness protection. The catalyst here isn't some breaking news headline, it's math, psychology, and institutional neglect all colliding at once. When the big funds can't move meaningfully into a $50 million company without owning half of it, they simply don't bother, which means these stocks are chronically under-researched, undervalued, and wide open for the rest of us. Think of small caps, like discovering a great restaurant before the food bloggers show up. The food is the same, but the price is completely different. Macroeconomically, they tend to thrive when domestic growth accelerates, interest rates stabilize, and risk appetite returns, which is exactly the cocktail the market has been slowly mixing. There was a moment in 2021 when small caps looked unstoppable. The Russell 2000 was ripping, retail investors were pumped, and everyone had a hot tip about some microcap biotech. Then inflation showed up to the party uninvited, rates spiked, and suddenly those same stocks dropped 30, 40, sometimes 60% like they owed someone money. The psychological wreckage from that drawdown was real. Investors who had tasted those gains watched conviction evaporate faster than a wet napkin in August. But here's the balance. Some of the sharpest macro minds, including folks like David Einhorn and smaller boutique managers, have consistently argued that the small cap discount has rarely been this historically extreme. You have to understand that this isn't the first time small caps have been left for dead in the late 90s. Everyone abandoned them for dot-com giants, only to watch small caps absolutely demolish large caps from 2000 to 2007. History doesn't repeat exactly, but it does develop a very recognizable accent. The volatility is baked into the DNA here. We're talking about assets that can swing 10% in a week on nothing but a thin order book and one frustrated institutional seller. But that same thin liquidity that burns you on the way down is precisely what launches you into orbit on the way up. And that asymmetry is the entire game. The biggest misconception is that small cap automatically means low quality or lottery ticket risk. Some of the most durable businesses in America started as small caps and quietly compounded for decades before anyone noticed. The fear is understandable, but conflating size with speculation is like refusing to hire someone because their office is small. So what do you actually do with this information? You don't go all in on a basket of microcaps with your rent money. That much is obvious. History rewards the investor who sizes positions appropriately, diversifies across sectors, and resists the urge to panic sell the first time a holding drops 20% for no apparent reason. The process matters infinitely more than the prediction. Picking the right entry point feels satisfying, but it's the discipline to hold through noise, rebalance systematically, and not let a Reddit thread reprice your entire thesis that separates the compounders from the casualties. Unemotional execution, boring as it sounds, is the actual edge. At the philosophical level, markets are just a system for transferring wealth from the impatient to the patient, and small caps are one of the few places where that transfer still happens inefficiently enough to benefit the prepared individual investor. Sizing, consistency, and process are the Trinity conviction. Without those three is just expensive optimism. The beautiful irony is that the very obscurity making small caps feel risky is the same feature creating the opportunity. If everyone already knew about it, the alpha would already be gone. We can be comfortable with uncertainty here because rational preparation, not prediction, is what drives long-term outcomes. Whether small caps rip from here or grind sideways for another 2 years, the investor who built a disciplined, diversified position at a historically wide valuation discount is playing a completely different game than the one reacting to each quarterly earnings miss. The outcome matters less than the framework, and that's a genuinely liberating way to invest. And if you want to take that same disciplined, research-driven mindset and apply it beyond the stock market, whether you're thinking about building wealth through real estate, renovating a property, or finding the right financing, check out our links in the description below because we can help you get started.